Okay, hello traders. Thank you for joining us. I'm Mike Sedek. I head up retail trading here at Lightspeed, and I'm happy to have Ralph Michele with me for this presentation on using options to add a new dimension to your trading. So, as you know, with the equities markets as stagnant as they have been, unless you're trading Apple, of course, it's important for traders to realize some of the benefits and opportunities offered in the options markets, and that's what Ralph will focus on today. So Ralph is an instructor and a trading mentor at cybertradinguniversity.com, which I strongly believe to be one of the top destinations for trader education. If you're not familiar with them, check out the website at cybertradinguniversity.com, and just a tremendous amount of resources for active traders. Please do keep in mind that Ralph is not a representative of Lightspeed, and this webinar is for informational purposes only. So nothing that we present today should be construed as trading advice or an investment recommendation by either Ralph, myself, Cyber Trading University, or Lightspeed Trading. We will be taking questions from the audience. We want to try to keep this webinar interactive. So if there's anything that you'd like to ask, please just type it into the webinar chat window. You can type in your questions as we go along, and we'll try to take pauses to address them, or you can wait to the end until, if you prefer. And of course, like all our webinars, this presentation will be recorded and will be uploaded to our webinar archives, and you can find all those at lightspeed.com/webinar. So let's not delay any further. Let me turn the presentation over to Ralph.
Excellent. Thank you very much, Mike. I really appreciate you guys having me on. Enjoy the platform, and really looking forward to sharing it with your clients. So let's get started. Obviously, you know, this is a funny picture of me with a bunch of charts behind me. To give you a background of who I am an options trader. I do most of my trading in options. I do some day trade stocks and some day trading of options. I'm a heavy technical analysis for my swing trading, which is predominantly what I specialize in with my options trading here. And what I want to show you guys here today is this. You guys have an amazing platform. It's very efficient. It works very well, you know, to move the pieces around. You get excellent data feeds, and so, you know, to add the dimension in the title itself of trading options. Now, I don't know how many of you are trading options right now, but if you're not, hopefully this presentation at least pushes you in a direction to start looking at options as, no pun intended, an option for you. And so without further ado, let's kind of get started here. We already went through disclosures. Again, you know, there is risk in trading everything, so you've already been kind of aware of that. I'm not here as a recommend anything, so thank you, Mike, for covering all that stuff. If you do have any questions, though, about the risk in standardized options, just go to thecibo.com. They'll get you a brochure, and any of your brokers will also provide that nice brochure for you if you're having trouble sleeping. I recommend it for you. It'll put you to sleep in about 5 minutes. So here are some reasons why we would want to trade options, guys. First of all, lower costs in trading stock. Okay, options are a derivative of the stock. So you're paying for an option, and basically what it is a contract. Okay, so and again, I'm not sure what everyone's familiarity is with the options market, but I'm just going to start from the basics. That way, if anyone is behind, or I don't want anyone to feel that we're starting from 30,000 feet in the air here. That's what I love about options in this first piece is it's lower than trading the stock. So yes, you could use a smaller account to trade options. That's one of the efficiencies, not cheapness, but the efficiencies in the options market is that you can use the options because it could take less capital out of the pocket. So we do risk management. We do manage all of our risk in every trade, just like you would on any stock trade. We like to look at probabilities and looking at profiting from them as well as the volatility in the market. Options can be used for monthly cash flow or to generate income, depending on how you want to trade them. We're always going to look at risk-reward ratios, and we're always going to pay attention to what's called risk-defined strategies. One of the big issues with people not knowing the options market is they think you have to have the money in your account for the option. And so you buy an option on Apple, which I do a ton of. I sell a lot of them, actually. You do not have to have, for every option contract, you don't have to have 100 or have the money in your account to own 100 shares of the stock. Okay? And just so you know, one option contract controls 100 shares of stock. So all you need to do is, when you look at the option pricing, is multiply, move that decimal place over 2, and that's how much physical money the broker, Lightspeed, will take out of your account to place that trade. So depending on how high of a stock you want to go, you can put out a decent amount of money with some of these options. It's no surprise, well, to me, but some people it might be, that I trade a lot of things like ISRG, Priceline, Baidu, Apple, because I am able to use very efficient markets with very good data from Lightspeed here to trade. And I'm actually going to show you a trade I took on Apple yesterday, and I made $200 on an Apple trade in my Lightspeed account in about 3 to 5 minutes. Now, I'm not recommending that anyone go out and do that tomorrow. Okay, please check your risk profiles and check with how you want to be as a trader. Okay, and so, but I just want to show you there's a lot of stuff we can do with options, from intraday trading to swing trading, and so basically there's a lot we can cover with options. I only have you for an hour, so it's really important to kind of really 45 minutes, because I do want to do some quick Q&A with you guys. But these are some key pieces that we will pay attention to when we start to really analyze some options trading. Okay, first of all, you got to understand how the options are priced and how the contracts and the orders. I kind of mentioned it already, that one option contract controls 100 shares of stock. We're going to talk about risk. How much money do you want to put out of pocket? How much exposure do you have to the downside? On a $100 stock, if you buy 100 shares, that's $10,000. If you put a stop loss in place, it still can gap past your stop, and you can get out wherever the market is the next price closest to your stop. That can happen with options too. But on that $100 stock like Nike, you can actually go out and buy a $3 and $4 option. So your exposure to the market is $4. Times that by 100 shares, you have an out-of-pocket exposure of $400. And this is why, when Mike and I were talking, why we wanted to do this demo for you guys, or this info for you, give this info to you, is because people don't realize that. I mean, I was trading Nike with a $4 option and basically doubled my money in a month. Now, you might say, Ralph, big deal, $400. Now it's worth $800. So you know what? If that's too small for you, then do 10 contracts and put $4,000 out, and have the option go to $8,000 and yield a 100% rate of return, or yield $4,000 for 30 days. Okay, so kind of part of the things we want to dispel is the myths behind options that they're difficult, and I also want to show you about placing options trades on your platform. Again, if you have any questions about your platform, please call Lightspeed. They'll be more than happy to go through with you how to get the options chain on your platform and set up the platform for you. And again, if you're not familiar with options, there are only two. Okay, you have the call options and you have the put options. That's it. Okay, so if you're looking to buy, go long a stock, okay, you're bullish, so you would buy a call. If you are bearish, you can buy a put. So think of it this way. The old-fashioned phones that we used to use, if you were to pick a phone up to place a call, you would call up, and when you're done with that phone conversation, you would put it down. Call up, put down, call up, put down, right? Pick up the phone for the call, put it down when you're done. So that's kind of the easiest way I can describe to someone what you want to do. If you want to be bullish, you're buying a call. You want to be bearish, you buy a put. And so what these are just contracts. That's it. So when you're looking at buying a call, it gives you the right, not the obligation, to buy the stock at a set price for a set time frame. Okay? Same thing happens with the put. Now, these are inverse relationships to each other. So if you buy a call when it goes up, you have to buy a put for it to go down. if you're buying a call with the right to buy the stock, then the opposite of that is buying a put, which would give you the right to short the stock. So for example, stock's at 50. Okay, you think it's going up, you buy the $50 call, it goes to 60. You buy the option for $5, it's worth 10, you make the difference. From the options market, the way they look at it, you have the right to exercise that option. So what is the difference between the $50 call and the $60 strike price? I mean, the $60 that the option is, the stock is at, $10. So that's what the value of your option has to be worth. Okay. On the other side, buying a put gives you the right to short the stock. Now that's where people can get a little bit of a rub because they're kind of confused. Why am I buying something to sell? You're buying a contract with the right but not the obligation to sell the stock. So let's say the stock's at 50 and it goes down to 40. You have the right to short it at 50 and buy it back at 40. So again, you have a $10 premium there, okay? You guys don't realize it, but you've actually been dealing with options pretty much almost your whole life. If you've driven a car and had insurance, or you've owned a home, you have insurance on that home, and if you bought that home, you put a down payment on it. Think of your call option as the deposit or the down payment you put on that house. You drove by a house, you like the house, you buy the, you sign a check, you write a check, and you hand it to the person. That check gives you the right, but not the obligation to buy it. No one will force you to buy that house, but that seller cannot sell to anybody but you. So in other words, you can walk away, they can't, right? So that's the right. You have that right, okay? That's what buying a call is. Same thing with buying insurance on your car. You buy a put, you bought put insurance. Your car is worth X amount of dollars. If the car's in a wreck, God forbid, no one's hurt, and that car is now, instead of being, a $50,000 vehicle, now that car is only worth $30,000. So your insurance company reimburses you the money to bring the value of that car back up, right? And you pay a premium, which is what your insurance company calls it, a premium for a time frame. You buy a 6-month or a 1-year policy. It's the same thing with options. We're paying a premium for a time frame to get a movement out of the stock, bullish or bearish, okay? So if you have the right to buy, there also is called the potential obligation to sell, all right? Now that's where, we can get a little dicey with things. You're actually obligated at this point to the market. If I sell you my home, I'm obligated to you. I cannot sell to anybody else, right? So when you sell something to the market, the reason I put the word potential obligation in here is because you can get in and get out of options just like you do stock. Market orders, limit orders, stock, or options, you can get in or get out of them as long as the market is open, okay? And if they're market orders, they're pretty much going to get filled wherever the market price is. So, you want to make sure that you know how to route your orders as well because, you want to be careful not to just pay the highest price out there, okay? So that's why it's the potential obligation. You can always get out of the trade. That's very important. You do not have to hold options through their expiration, okay? They're a liquid market. You can get in and get out of them. So what the call, when you sell a call is you have the right, the potential obligation to sell, and selling of the put has the potential obligation to buy. Okay? If any of that kind of, didn't jive with you, just let it go. Concentrate on what you can. This, Mike is going to record this for you, so you'll have the ability to replay this as many times as you want, and until you get it down. Options aren't difficult. They're just different. It's kind of like driving a stick shift. You can't read a book on driving a stick shift. You actually have to get behind the wheel of that car, and that's really how you know the touch and feel between the gas and the clutch and the stick, and figuring out how to actually make that all work. But it's not a difficult process to learn how to drive a stick shift. So this is your options chain that you would see from Lightspeed, and what you have here, right down the middle, is what's called the strike price. Okay, I've got my cursor kind of circling around the middle of this thing here, and you control the shares of the stock at any one of these strike. Now I only picked a few, okay, but you can control the stock at any one of these $5 increment strike points. So if you want to control Apple at $615 a share, you have the right and or obligation, depending on what you want to trade, to control it at $615 a share when the stock is, what, at 620 something? Forgot where Apple closed today. 624. So basically, this is where you can look at, number one, the expiration month. All options are designed to expire. That's the whole point of them. Okay, so if anyone says that they don't know how to make money in options because they always expired on them, well, they don't know how to trade them. They're designed to expire. All right? And so what we have here is, just to read what we have on this options chain. You have the stock, the price of the stock, how many shares it's been trading that day, and the strike price of the option, when they expire, something called time value, which is really important in your options. How much is this option in the money or out of the money? So basically, what is the actual premium that this option should be worth? And I can go into that in a minute. And then, your intrinsic value and your bid ask, okay? The net change telling you how much it actually increased, and the last price, okay? So that's a lot of information to take in, okay? So how are we doing, Mike? Any questions you have for me?
No, so far so good.
Excellent, okay. So that's your standard options chain. That's what we're going to look at to basically pay attention to what we want to see in the market, all right? So we can kind of dive in a little bit more. Now, I already spoke to the guys at Lightspeed. This is something that's coming out on their platform. It will be here pretty soon. Again, talk with Mike and the guys. This is called your option Greeks, okay? It's a very important piece to trading options. I'm pulling this information right off of the NASDAQ, off their website, just NASDAQ.com, and just grabbing the options chain on Apple and correlating the information here with my options chain right here. What I like about this is that the delta gamma, really theta vega rho is very non-existent. Can help me with knowing a couple of things. The big thing I want it to help me with is what it help me with probabilities, which is the piece of delta that people don't really realize. But in reality, I like to know that there's a high probability that these options are going to expire in the money. Delta goes up to a number 1. It can't go higher than 1. Okay, so what this is telling me is that the 605 April options are kind of telling me that the stock's got about 79% probability of expiring, of Apple being above 605 or above on expiration day, which is in a couple of weeks here. So I like to know that, so that way I know when I'm trading it if I'm a high probability type trader or a low probability type trader. And so there are a few pieces there that I have to also teach you to understand what that delta can do and your probabilities of making money on the trade. Because this isn't telling me the probabilities of making money on the trade. This is just telling me the probabilities that the stock is going to be above 605. And it's just a rough estimate. This is kind of like the curb appeal. You drive by, you're looking to buy a home, you drive by it, you say you really like that house. So it warrants you to then write the deposit check, get an inspection done, and start your due diligence. So right here, what I'm doing here is a drive-by, kind of just saying, okay, is this an option I'm willing to look at in terms of Apple working, in my direction for a small period of time. And so when I'm looking to trade on the Lightspeed platform, you have a quote bar, you have an execution system that you can go through, and it's very efficient. I can look here at the level 2 on this, basically this $600 May option. This is the $600 call option. I can buy them and sell them. So it's telling me that the Philly, the ARCA, Amex, the NASDAQ BATS, but the Boston Exchange, this is where they're at with the price, okay, on the bid and the ask. So I can basically see the same information that I'm seeing on a stock, but the difference now is that you have a plethora of options that you could pick from. I picked this $600 strike. You can see that I picked it right here, okay? and this was the 10 contracts I chose. Here was the trade. Okay, so what is this? This is military time. So so basically that was at 3:48 in the afternoon yesterday. Okay, 10 contracts bought, and then here is at 3:51 in the afternoon. So 3 minutes later, I sold those 10 contracts. Okay, and there's the total P&L on the trade. So what was I doing, right? What caused me to make $200 there? Well, first of all, I bought the option bought 10 contracts, okay? And then when I sold the option, I sold it right back to the market 3 minutes later and made 50 cents per option for 10 contracts, right? No, 20 cents. Sorry, 20 cents per option for 10 contracts. Sorry, adding the wrong numbers there. So what was I doing? This was my execution system, right? You can see my screenshot here with the time yesterday afternoon, just about 4 o'clock. And so this is what I was looking at. This is my information. I scrunched it together a little bit so that way I could get it all on one screen for you. But what am I looking at? Well, first of all, I'm using their charting system here. I'm using their yearly chart that I zoomed in on to look at the last. I happen to look. This is no just a random number, but looking at the last 73 days, and I'm looking at the 1 minute chart. And so what I noticed here coming into the close was a little rally into the close here where stock came up, hit its head, pulled back to a support line, and then found support and ran higher. And so what I noticed right here on this candle, this is a inverted hammer. Oh, I'm sorry, this is a hammer, which is signifying the end of a downtrend. Again, I told you I am an options trader that uses technical analysis. So I saw this, and I was like, okay, well, let's see if this thing starts running, and it was. So I was actually playing around with other trades, and I came, and I was getting some things off the screen, and I was like, oh, you know what, let me see what Apple's up to here. And so for the last couple of minutes right in here, I saw it kind of breaking through this resistance line and push a little bit through here. And I totally believe in this phrase, bulls make money, bears make money, pigs get slaughtered. There was no reason for me to go out and be greedy. I felt that 10 contracts, 200 shares. 10 contracts, $200. That's a nice day's pay for 3 minutes of work. Could I have made more? Possibly. Do I care? Not really. If I worry about trying to make more, that's where the problem comes in. So again, using the Lightspeed platform here, as you can see, I've got Apple up with the time and sales. Looking at all the exchanges bringing through their quotes, and I've got my normal order entry window right here that I'm kind of highlighting, just circling around it. And actually, you know what? I do have a. Here we go. Drawing a highlighter. So I've got this right here, and sorry, it's in yellow, which is my standard order entry and level 2. And then over here, which is again, sorry, it's in yellow, is my options order entry and my level 2 for my options trading. So I do have the ability to look at both at the same time. I love to be efficient. I am a very efficient person in the market. I don't want to spend $628 per share and take that out of my account to make a $2 or $3 move in the market, right? So why would I spend on 100 shares, buy $600 and something thousand of stock just to get $2 or $3 a move and get out of the trade and having that exposure to the market if it's going against me, when I can go out and trade an option that's worth $47 right here, $47 a share. Much more efficient use of my dollars. Okay, so that's why I'm looking at options the way I do. Now, again, I'm using the platform. I'm using the charting. So when we're looking at, let me go over here and get out of this drawing tool, erase drawings. There we go. I'm looking at the chart. So I'm using the charting software that you have here from Lightspeed to throw on some moving averages, okay, on the daily chart. and I have my 1-minute chart. So I'm using my information to gauge the market. So let me show you what I'm looking at here. Here is my platform today, right? I've got everything. I do have 2 monitors that I use. Sometimes I'm using a second computer, so everything's not running all on one computer. But this is my options chain right here, okay? So I've got that chain that I'm going to pay attention to. Now, what you do is you come up here and hit your programming here. You come up to grab your options information. There's your quotes. Okay, it's all here for you. Okay, you might just have to ask them to turn it on. Okay, and you can start using it. So you've got your ability to place your, check your options quotes, do options chains, options times and set time. Oops, option time and sales. So you can actually see the prints going through, depending on what type of trader you're going to be. Okay. And then here's your options trading screen right here. This is kind of where you can put in your order. Now it's actually queued up to VVUS for a specific reason. Here's a trade that I want you guys to, for an educational purpose only, okay, pay attention to. All right. This is a very unique opportunity with VVUS. I took this trade the other day in my personal account. Where I did a standard, what's called covered call. Okay, what a covered call is the oldest option trade out there. You buy the stock, you sell the call against it. The stock rises in price, past or up to and through your strike that you sold, and the option will be taken away from you. The stock will be taken away. What do I mean? Well, you buy a stock at $50 a share. You sell the option at $55. When you sell an option, they put money into your account. So you sell the $55 option to the market and saying, hey, Mr. Market Maker, you have the right to take my shares from me at $55. Remember, you're selling it, right? So that's your obligation. So when the stock gets to $55 on expiration, you will take it. Now, there are times when the options are exercised early, but let's just talk normal situations. It's Friday, options expiration, 4 p.m., option market closes, you lose your shares, okay? You bought it at 50, you told the options market, take it away from me at 55. So what do they leave in its place? Well, they leave $5 per share. You made $5. Let's say they paid you $1.50 per option for the right to do that. So 150 times 100 shares is $150. So for about 30 days of time, you made $650. Nice trade, right? On that principle, on that basis, I want you to take a look at what's going on here with the option pricing in VVUS. All right, I've got pretty much all the options up here. Now, in the scenario I just spoke to you about, you want to sell an option, okay, against the stock, and you want to sell it a strike or two out of the money, okay? But pay attention to the last price here, okay? This is what the option is trading for. Now, if anyone out there is a covered call trader, if anyone out there knows what I'm talking about here, you're going to start to salivate at this point. And the reason for that salivation is not because you're hungry, it's because you're looking at the dollars you could make here, okay? Let me just explain what I'm saying. The stock is at $22.35. If I sell a $15 call option, okay, I'm going to lose the difference between $22.35 and $15. They're going to call that stock away from me at the strike I sold. So Ralph, why would you do that? That doesn't sound like an intelligent move. You're right on every occasion except for the volatility in this option. Look at this. The stock is at $22.35. The difference between $22.35 and $15 is what? Would that be $7.35 if my math is correct? How much are they paying you for this option right here? $8.30. That was the last price. So what am I saying? Boil this thing down. You buy the stock at $22.35. You tell the market, take it from me at $15. I'm going to lose $2.35 a share the second that you place that, the second that they call the stock away from me. Okay? But the right to sell it I'm going to get paid $8.30. So I lose $7.35. I make $8.30. My net is 95 cents. Minus your commissions and any exercise fees that you have to pay, you're making $95 for placing a stinking trade. Stock could drop all the way down to $15 a share. In fact, the stock could drop less than that, but you can go all the way down to $15 a share, and they'll take those shares from you, and you're going to yield 95 cents on, or $95 on a $2,200 investment. Now, that's not a very sexy trade, quite honestly. Covered calls aren't. They're not the 2,000, 3,000% trades. But this is what I'm showing you is real. This is actual trading with high probability. Okay, now we can look at another trade of a lower probability. That's fine. I'll do that right after this. Okay, but for you guys learning how to trade options that you only are one-dimensional, you're only looking at just stocks, I'm telling you, you're missing out on a big ball game here. Okay, it's almost like you paid the admission to go to see a baseball game. I happen to be a Yankee fan. Okay, and you basically spend the entire time in the men's room. Not really an effective use of watching when you went there to go watch a ball game, right? So, you know, if you're just trading stocks, guys, girls, you're leaving out these huge opportunities. This trade right here, and again, I'm not recommending this for anybody. Go practice this. Go take a look at it. See if it fits your risk profile. The stock can drop. Here's the day chart. Okay, let me just make this bigger. And this is a cool thing about the features of your platform. You can kind of move everything around wherever you want and customize it. The stock was at 13. It gapped up, and now, let me zoom in. I like candles. I'm a big candlestick guy. It's found a nice support, you know, and then it's ran higher, and it's found another support at about 20, and now we've got another decent support here at about 22. Okay? I want to get called out of this trade, folks. I want to make money. I hope they do it early. So the second they do it, I'm going to do it again. Okay? Now, I'm pretty confident the stock's going to stay above 13, but if it doesn't, and the stock drops all the way down to 13, if I sold a covered call for April, can I sell a covered call again for May? Yeah. So I can basically look at my options chart chain right here and just go over to, you know, over here I can look at, these are all the Aprils, and they're the near for April. I can go into the Mays, right? Now, the option pricing will change, and this is something, again, I don't have enough time to go through all of this stuff with you, but I can go out and look at selling this option. Right now, that last price is $9.80. If the stock got down to 13, I'm going to bet that that option is going to be worth about $2 and change. Okay, so again, the ability to sell that covered call against stock, that's a loser, but in reality made me money. Okay, that might tweak your head a little bit. It's a fascinating trade because the volatility in these options for VVUS is pretty insane right now. The volatility is telling me, you know, if I look at what is intrinsic versus extrinsic value, you know, here, let's go to the Aprils again. You know, I can see that the this option at 20, okay, the stock is at $22.36, that basically the true premium, the true value of this option is the difference between the strike price and the stock price. So $22.36, subtract 20, the actual premium is only $2.36. What is it going for? $5.20. You're paying double what it's really worth to trade this option. And when I see that type of stuff, I salivate because I see potential profit there. Okay? So that's kind of a very weird scenario on what is the oldest option trade that people usually look at, which is called a covered call. All right? Mike, any questions there? How are we looking? Awesome. Okay. Awesome. Now, remember, guys, I don't get your questions, so they go through Mike, and Mike will send them to me. Okay? So this is a very fascinating trade from that standpoint. Other things that I'm looking at, you know, what's going on in the market? Well, let's take a look. You know, right now, even though the market was down today, would you all agree that that the market is in an uptrend, right? So, and if you're not sure of that, oops, let me go over here. Here's the SPY. If you have trouble reading, let me make this bigger. This is the 1 year chart of. Let me zoom out. Okay, here you go. Since August, here's the run that the spiders have had. Okay, so if anyone is confused as whether or not that's a bullish or a bullish uptrend, let me just clarify that for you. We're doing pretty well. Okay, we're doing pretty well on a lot of very weird economics going on in our country. So this is very, very interesting. Now, that being said, let's go take a look at AMZN, right? Amazon now had a very big drop today. Oops. But there's a pattern here that is formed called a bull flag pattern. Let's see if I can go to the highlighter, choose pen color. It's on red, but it's still on yellow. Let's go to the pen. Okay. So what a bull flag tells me.
Ralph, sorry to interrupt you. Just another question came up. If you
sure, absolutely.
If you get some extra time, just getting some questions about people are interested in some other strategies to use with stocks that have high volatility.
Yep, absolutely. There's a lot of option strategies that you can put in the market. Buying a directional call or a put, selling the calls and puts, converting them together to make other strategies what are called diagonals and calendars, what are also called vertical spreads. You could take advantage of the actual overall volatility in the markets right now. We pay attention to what's called the VIX, the VIX. Actually tells us what the overall volatility is in the general markets. And the VIX is actually been decreasing pretty significantly. It's at 16 and change. The VIX works as an inverse relationship to the overall markets. So as the market's going up, the VIX is going down. What the VIX is telling me is it's a fear and greed indicator. And when the market goes up, typically the pricing of options decreases. So right now has been an amazing time in the markets for option pricing to be very cheap. So when you see something like that VVUS trade that I looked at, the fact that it has a huge amount of volatility isn't the norm going on right now. The fact is that a lot of options in the market right now are priced very, very cheaply because the overall theory or fear indicator, the VIX indicator, is actually down. So that helps us in terms of buying options. So this was a nice segue into what I'm going to look at right now. Amazon is almost a $200 stock. This little ugly-looking flag I just drew here in red, this is what's considered a bull flag pattern. Now, what's very interesting today is where it stopped here, and even though I drew a very ugly line, I wanted to kind of highlight what this looks like. This is what's considered a trend continuation pattern, and your entry is going to be closer to this side up here at the 198 to 200 level. Okay, so what I am looking at is a May option to go out and buy a call because I'm bullish on Amazon and looking to capitalize on this upward move in Amazon that I believe it will continue. Now I'm taking making an educated bet, so to speak, on placing this trade based off of what I see in the markets and using my technical analysis to use that information. Okay, so let me just erase that, and there we go. Let's get this a little bit smaller and push this up here. Okay, I don't know what that is. All right, so what I'm looking for is to look at these May options, which I've got the options chain right here, and I'm looking at basically saying, okay, well the stock is at 190.93. So if I was going to go look at this 190 call, okay, or even like the 185 call, it's going for about $10. Okay, now what I'm looking at, guys, is I'm looking for the stock to make a move from about 180 to about 205. That is a $25 move. when it breaks out of about 195, I want to enter. So if I'm entering at 195 and I'm expecting let's say a $20 move, okay, my option is going to increase, you know, a pretty decent amount, and we can figure out, and I can show you guys how to factor in what your pricing is worth. But just for a really quick, you know, just demonstration, this 185 call is going for $10.85. If the stock is at $220 when I expect the move to happen, the intrinsic value on this option has to go from 185 to, let's call it, you know, 185 to 220. So that's $25. 220 would be, $40 of value. So this option should be worth $40. I'm paying $10.85 for the option. Okay, that's, and I can go into a much better version of how to price out this when it happens, but just, you know, let's just kind of ballpark it. I'm spending $11, $10.85, or $1,085 for one contract, thinking that Amazon is going to make a run off of the bull flag breakout and break out at about 195. So I'm not getting in tomorrow until the stock gets above 195. That's my opinion. I'm expecting it to go up from 195 to about 220, 225, and I will cash in that option. I'll basically sell it back to the market. That is basically using what is a $200 stock and using how much. Look at the size difference. You can spend $193 a share, or I can spend $10.85 a share, right? My money tells me I'm more efficient here than coming up here and buying the stock at 193. Okay? So again, looking at a stock, making a quick move, going to happen in the next month, want to make a nice premium. It's going to be worth, the option can be worth it. Roughly, you know, let's just call it the $40. Okay? So I'm paying, you know, paying $11 for it to be worth about $40. That's a 3-to-1 reward to risk ratio, right? I'm looking at making $30 and I'm risking $10. Now I haven't even put a stop loss in. I haven't put a stop loss in on this yet, but you can put stop losses on your options. So I won't have to expose myself to losing all of that $10.85. So as a trade to take advantage of what could be a potential nice run in Amazon up from here, this is a trade I could put on. Okay? What else you got for me, Mike?
We're good. Let's keep going.
Okay, awesome. So, you know, again, the overall markets are in a upward trending bias, right? We are uptrending. So most of what I've been looking at with these Amazons and Apples and, you know, even, you know, I like high price stocks. I get very good pricing, as you can see. I'm using $10.85, $1,000, $1,100 out of pocket for one trade. Isn't a large amount of money to be putting out. There are stocks, you know, that have been going down. You know, here's MOS. So if you're one of those guys that likes to look at the downside, let's kind of let's zoom out here to give you an overall picture of what the market's done, right? Clearly, the long-term, you know, since March of last year, okay, February-ish of last year, this thing is in a huge downtrend. And what we're seeing now is that the stock just broke out of a 55 support line. I mentioned this to a bunch of traders this morning, and we talked about it yesterday, that starting to set up an order to look at the potential for this break to 55. And when it breaks 55, the stock could make a $5 move pretty quickly here, because the overall market's telling me, look, it went from 60 to 55 and then back up to 60, you know, 60, 55, back to 60, and it does it pretty quickly. So there's nothing wrong with me I'm not out of the realm of possibilities here, or thinking, you know, unrealistic to think that the stock has the potential to get down to 50, possibly even 47. And so again, looking at MOS, now we're looking at something that is counter-trending the market overall. The market was down today. This was down today. Markets have been going up. MOS is going down. So looks like they're not, you know, haven't been doing too well. And I go on the other side of the trade here. I go on the other side of my chain, the options chain, and I look at the puts and say, all right, I'm thinking the stock is going to go down. So let me look to capitalize off of the stock moving down in price. Now, this is a $53 stock. 100 shares would cost you $5,300. If I go out in the option market, and let's go out, buy some more time here. Let's go out to May. I can look at buying the $60 option for $6. It's bid asking $6.85 to $6.75. 10-cent difference there. You give up to theoretical. Is somewhere right in between this. You have a 10-cent window, right? Because let me zoom over. Let me scroll this over a little bit. Oops, wrong one. Let me bring this over a little bit more. Okay, so what we're looking here is that the time value within this option and the last price. So, well, it's not showing up, but it could be because of after hours. Sometimes the quotes after hours, you know, they're not showing us all the data. So basically, this option is going between $6.75 and $6.85. If you were going to buy it right now, just like a stock, you would want to get $6.75, but in reality, you're going to get closer to $6.85, right? So we're using $6.85 per share to control a $53 stock, okay? 10% of 53 is $5.30, so what's that, 12%, 13%, something like that? Let's even call it 15%. 15% of the stock value is the amount of money I have to put out to control this share, the stock, at $60 a share. Now, if this stock drops the $7 that I'm anticipating that it will do, it does make $5 moves pretty consistently. I'm expecting that this thing could potentially drop down to 43. I will capitalize off of putting a small amount of money out of pocket to control the stock, giving me the right but not the obligation to control it, and I can get out of this trade anytime I want, right? So when you queue up the order, you simply just, you know, come over here to MOS, option 1, sorry, and I go over and I say go to the May. Okay, I want to go to the 60s. All right, now I've got one contract in there. Guys, be small, okay? Aim small, miss small, okay? Something I learned when I learned to shoot a gun, okay? Aim small, miss small. Don't be a hero in the market. If this is your first time starting to trade options, go trade one stinking contract. It only going to cost you $685, right? So what I do is I load up the order. I want one contract call, right? And I want to buy to open. Okay, so I will go out there, and obviously I'll set my limit order. Market's not open right now, so I'm not going to place this, but I want to go out, buy to open, right? That's the BTO, buy to open, all right? And then when I want to get out of it, I go to the STO, the sell to close, okay? Just like you would on a stock over here. You buy, you sell, right? Same thing over here. You buy, you sell, okay? This allows me to capitalize on a stock moving down, and I don't have to have all the money in my account to control the shares. I just have to have the money in my account to control the option, because I do not have to exercise the option. Okay, is that clear? I mean, this is the efficiency of these markets, and quite honestly, guys, if you're not involved in it, you know, you're giving up a huge amount of potential to make money. And if you don't learn it correctly, it's just like stock. If you don't know how to trade anything correctly, then all you're doing is throwing good money out after bad. You know, I mean, I don't think any of you are going to sit blindfolded at a computer, type in whatever you could see on the keyboard, not even look at anything, and just go say, how much money I have in my account? I'm all in. I don't care what the stock is. Who cares, right? No one does that. So what you need to do is learn how to be efficient with these markets, efficient with this trading. Learn how to do it. Spend a little time to understand how to trade correctly. You've already got an excellent platform to be placing trades off of. You know, you're smart enough to be here, right? Smart enough to have an execution platform that can help you efficiently route your orders to the market. Just do it correctly, you know, and learn how to do it the right way. And that's why we're here to kind of show you guys some of the possibilities that you have in the market. So what we've gone over so far, and I've only scratched the surface, guys. I mean, this is like the ice cube. I mean, the iceberg, right? You only see so much out of the water. And so we've talked about a very standard covered call. We talked about buying a call outright because we're bullish. And we talked about buying a put outright because we're bearish. Now, are there other strategies I could talk to you about? Sure. But I don't think Mike or anyone else really feels to be here until tomorrow at this time. We'll talk for 24 hours.
Yeah, we'll do it on the next webinar. We'll definitely have you back.
Exactly. So if you guys are more interested, I asked Mike if it's all right. I do trade with people. I will be doing a free session tomorrow on trading. Mike did tell you that I'm an instructor at Cyber Trading University. So if you are interested, just come find me right here at cybertradinguniversity.com. Right here, nice little free options course, okay? It says free because it doesn't cost you a thing. Just show up, all right? Link in here, and you can come listen to me tomorrow. I'm doing a technical analysis event at noon, and I'm doing an options event tomorrow at 2. You're more than welcome to join me. I'll continue the discussion that we've left off here at. And I will be continuing to talk to you about other possibilities within the market. Because if you think this is good, and I've only had you for an hour, get me for another hour, and then get me longer, and you'll really see a lot of the possibilities you guys have.
All right, great, Ralph. Thanks so much. We don't have any other questions, so I think we can probably wrap it up. I really hope that our traders start utilizing some of these strategies as you presented. Just a tremendous amount of opportunities in the options markets. We want to make sure that everyone gets some exposure to them. So with
Absolutely.
that, yeah, we'll end it on that note. Thank you, everyone, for joining us this afternoon, and I hope to see you back on our next webinar. Thanks again, Ralph.
Oh, well, thank you very much, and thanks, everybody, for being here. Have a good night.
Have a good night.